Thank you so much for clicking on this video. Today we are talking the International Monetary Fund, the IMF. This video was inspired by my research into what is going on in Kenya, the Kenya protests, and also Thomas Sankara and also Ibrahim Traore. This name kept coming up quite a lot, and I figured it's time I educate myself and also share my findings with you guys. And so here we are in this video. If it's your first time seeing my face, my name is OHLEEN, and on this channel I try to balance conversations on things going on the continent, the good, the bad, and the how-to. I had a stint in 2023 and early 2024 of traveling solo in Africa, and I really enjoyed my time, and that created a hunger for more of that, but also to just get to know more about the continent without necessarily getting on a plane. So I say that to say, today we are talking about the International Monetary Fund, the IMF. This name, this word comes up a lot when you're talking about African countries and the problems they have, and a lot of it stems from lack of funds. It stems from debt. And so today we're going to do a breakdown as to who they are, how they work, and how does this connect to future protests or future dealings on the continent. The International Monetary Fund, which is known as short IMF, is a global organization, and they aim to promote economic stability and growth. Currently, it has 190 member countries, and it is governed by its member countries through a board of governors. The day-to-day operations are managed by an executive board representing 24 constituencies. Its headquarters are in the US in Washington, DC, and their financial resources primarily come from member countries, which is to say each member country pays to join and to participate, to vote, and to be considered for lending, etc. Larger economies pay more to join, and therefore they can borrow more and have greater influence in whatever that looks like within. The largest quota sits with the US, and it's at roughly $113 billion. The smallest quota sits with Tuvalu. Tuvalu is an independent island nation within the British Commonwealth. Theirs is $3.5 million. So very similar to my conversation about the World Health Organization, where essentially the funding comes from member countries, and any additional funding comes from the borrowing arrangements, which basically earns the organization more money through interest. And as of 2025, the IMF can access up to $1 trillion. From the African continent, the IMF has 54 member countries, and Ethiopia was the first to join, and they joined in 1945. And as of the making of this video, Egypt holds the largest debt from the continent, followed by Kenya. Egypt has a debt of 5.47 billion US dollars, and Kenya has a debt of 2.21 billion US dollars. The numbers vary based on the exchange rate, etc., but these are estimates close enough to what I could find. Eswatini has one of the lowest IMF debt profiles, which comes in at 9.81 million US dollars, and this reflects, I guess, cautious borrowing and also a smaller economy. Second to Eswatini is Lesotho. Lesotho has a debt profile of 20 million that they borrowed from the International Monetary Fund. And as of the making of this video, only 3 African countries do not have any debt with the IMF, and these are Libya, Botswana, and Eritrea. I'll put on the screen a list of countries in Africa and their current debt value from what I could find in my research. So how do you actually qualify, and what's on offer from the IMF? Essentially, there are product offerings, there is what you select that is relevant to you, or products that you apply for, funds that you can apply for, and you have to meet the criteria. So firstly, in order to qualify, in order for you to even apply for funding, you need to be a member country. So remember the quotas we talked about at the beginning of this video. Essentially, you pay a fee to join the organization, and the fee is based on the size of your economy and many other things, but essentially it is really centered around the size of your country. Then the country must demonstrate, in order to qualify for a loan, you must demonstrate a balance of payments problem, meaning you can't finance imports, service external debts, maintain adequate foreign exchange reserves without external assistance, essentially. And once your application has been accepted by the IMF, typically with a repayment loan time of 3 to 5 years. So besides agreeing to the terms, which will be 3 to 5 years of repayments and the repayment term, you also have to agree to how are you going to get yourself back in order to make sure you don't find yourself needing to borrow again. That's part of what you must agree to. And so this comes in the form of tax reforms, privatization of certain things, certain organizations or institutions, etc. All in effort to pay back the debt and also to commit to a restabilization plan to make sure you don't find yourself in the same position again. Kind of like the step change of countries. This is where Kenya becomes relevant, because this term and condition is part of the reason why they felt they needed to tax the air, to tax the sky real estate for their people and for their country, in order to start paying back the debt that they currently have open with the IMF. You might be wondering, so what happens if you don't run them back their money? If you do not pay on time, you know, what will happen? Essentially, you get charged a penalty, and also you get charged interest that is more than what you had originally agreed to. So naturally, it's in your interest to pay on time and to pay back, because it goes from bad to worse. Essentially, you get charged a penalty and you get charged interest, which increases the burden. So you also risk losing access to the club, which is to say you probably won't be able to borrow more should you need it down the line or in future states. Also, the funding from the IMF is given in phases. So if you start missing repayments, the IMF can suspend any further disbursements under the existing open loan that you have. An example is in the 2000s, essentially Zimbabwe fell into arrears, and this led them to lose voting rights, to lose access to further loans, and to get onto a payment plan that is adjusted according to, I guess, what they could afford. But you just run into problems that you don't want. Just like any borrowing situation, pay back the money, pay back on time. Now, as of what is actually on offer to borrow against, the products that countries can pick from, I'm going to make that into a separate video, and it is going to be dependent on the uptake of this video and also the questions that fall under this video, so that I can essentially tackle it all into one. So I hope this video has been insightful and it reaches the right audience, and please ask questions or comment on anything that needs correction in the comment section below, and I will make it part of part 2 of this video so that it's more relevant. So I'm going to stop here. Thank you so much for staying to the end of the video. In the meantime, stay safe out there. I will see you in my next video.